Home Sweet Home. Materials provided by Genesis Financial Management. Your home is one of the biggest purchases you will ever make. Deciding whether to take the next step from renting to buying involves consideration of many variables. The 4 C's of credit. Capital, that's how much money you have. Capacity, that's how much money you're capable of paying. Credit history, that's how you've paid in the past. And collateral, that's what secures the debt. So what a lender wants to know is your income, how much money you make, your debt, how much money you owe, and the amount of monthly payments you have to make, and your payment history, that you're willing to pay back the money that you owe them. Your credit report. There are 3 national credit reporting agencies reporting information to the credit bureaus: TransUnion, Equifax, and Experian. A lender may pull a credit report from 1, 2, or all 3 reporting agencies. Evaluating your credit information. Lenders may require or recommend that you have at least 4 lines of credit reported on your credit report, such as mortgage, credit cards, car payments, student loans, and installment loans. Lenders want to see that you've paid the bills on time, that no payments have been over 30 days late, and that the accounts have been active for at least a year. Rent payments are not usually reported to the credit bureaus, but can be verified and used as one of the 4 lines of credit. A lender will check to see if you have any collections or judgments, which are outstanding bills that you have not paid. A collection is specifically a bill that has been turned over to a collection agency for collection, whereas a judgment is a ruling from the court that you are liable for a bill. Usually, they have to be paid in full before you get a mortgage, and you may have to wait 1 year from the date of payoff and have no other late payments. With a bankruptcy, you'll usually have to wait 2 to 4 years from the date of discharge, and you may need to have 4 lines of current credit or alternate credit with no late payments before applying for a mortgage. A lender is usually not willing to give you a new loan when you have not lived up to the terms of your existing one. Your credit report also shows who has checked your credit report within the past 90 days. Too many inquiries would be a red flag. You would have to explain why each borrower checked your credit and whether you borrowed funds from them or not. Loan approvals may be based on your credit score or your FICO rating, or your whole financial picture and other compensating factors. Your FICO score is a rating system that takes into account your payment history, the number of open accounts you have, the amount of credit available to you, current balances, how long you've had credit, and the types of credit accounts you have. The FICO scoring system is from 100 to 900. The higher the score, the less the risk to a lender. 650 and above is usually considered a good credit risk. If you score too low, your loan may be denied. Making positive changes in how you handle your credit and payments will improve your score. So reduce the amount of outstanding balances, pay your bills on time, reduce the number of open accounts, and close any unused accounts. Lender's grading system for interest rates. A grading system based on your credit or FICO score is used to establish interest rate on most loans. Each grade is assigned a FICO score along with other risk criteria. Banks grade their paper or loans using a system similar to the grading system used in our schools. The grades range from A to D paper loans. An A paper loan is the lowest risk with the best interest rates, so you cannot have any recent late payments, you have to have a high FICO score, and you have to meet the loan underwriting criteria, whereas a D paper loan is a higher risk, which means higher interest rates. If your payment history is not good, you are a higher risk for non-payment and your interest rate will be higher. Higher risk loans are sometimes called subprime loans. They usually have higher interest rates, higher down payments, and higher fees. If you can wait to borrow the money, you can get a loan at a much better term than those offered when your credit is still bad. Repair your credit and then reapply for a loan. Subprime loans often have prepayment penalties, so refinancing within 1 to 5 years once your credit is better could be very costly with the penalties. Pre-qualifying for a mortgage. Contact a mortgage broker or lender to get pre-qualified or pre-approved. Pre-qualified means that the loan officer goes over the information that you give him or her and tells you approximately what you qualify for. None of this information is verified. Whereas with a pre-approval, the loan officer collects all of your paperwork, takes an application, checks your credit, and submits it to an underwriter for review. The underwriter will approve your loan for a certain dollar amount and give you the conditions that have to be met for the loan to be closed. All of this information is verified. What are debt ratios? A debt ratio is a relationship or comparison between two numbers. For mortgage lending, there are usually two ratios or relationships that need to be considered. You have your housing ratio and your debt or back-end ratio. The housing ratio is the relationship between your gross monthly income and your new house payment. The house payment, also called PITI, includes your principal and interest, your taxes, and your insurance. Each loan program has a limit or a guideline on how much of the gross monthly income should be spent on the housing payment. Rule of thumb, it's between 28 and 33% of your gross income for a house payment. Here's an example of this particular debt ratio. $3,643 is your total income, $600 is your total debt. So if we multiply the income by the allowed housing debt ratio, it would equal the maximum monthly house payment. In this scenario, the maximum monthly house payment would be $1,129. With a back-end ratio or a debt ratio, the relationship between your gross monthly income and the new house payment plus any other debts you are already obligated to is considered. Rule of thumb, it should be between 36 and 45% of your gross monthly income minus any current debts. So here's an example. You multiply your gross monthly income by the debt ratio subtracted by your current monthly debt, and it'll equal your maximum monthly house payment. So in this example, you can see that the monthly gross income is $3,643 multiplied by 40% debt ratio subtracted by 600, which would make the maximum monthly house payment $893. Debt ratios are guidelines meant to limit how much you spend on the house so that you can have money left for other normal bills and expenses. A lender must use lower payment of the housing ratio or debt ratio to qualify you for a mortgage. The amount of the monthly debt payments you will have directly impact how much you can borrow. It's your responsibility to make sure that you don't spend more than you can comfortably afford, not the lender's. Ratios are not usually set in stone. And to make any exceptions to the rules, a lender must be able to make the case that you can afford higher ratios. Be sure to tell them about any compensating factors that might help your case. What documentation will you need? You will need 2 years of tax returns, 2 years of W-2s, 2 months of your bank statements, pay stubs to cover a 1-month period, pensions or Social Security award letter, list of monthly bills. The basic loan types. Conventional. These loans are insured or guaranteed by private investors, not any government agency. They have standardized terms and requirements set out by the Federal National Mortgage Association, also known as Fannie Mae, or the Federal Home Loan Mortgage Corporation, also known as Freddie Mac. Fannie Mae and Freddie Mac set ratios and underwriting criteria. There are 2 basic types of conventional loans, conforming or qualifying loans, and non-conforming or jumbo loans. Fannie Mae and Freddie Mac set a limit for the maximum loan amount to meet their conforming rates, or a normal loan size. Non-conforming loans are those that exceed that limit. FHA loans, or Federal Housing Administration loans, are government-insured financing. There are the maximum mortgage limits. The FHA sets the underwriting criteria and debt ratios, and it has a low down payment. Whereas veterans loans are government-guaranteed financing, only available to those who have been in the Armed Forces or National Guard, requires no down payment, and they set the ratios and underwriting guidelines. Various state government mortgage programs. States may participate in their own mortgage programs through a state housing authority, usually targeted to low-income or first-time home buyers. Down payments. Conventional loans. They usually require anywhere from 5 to 20% of the purchase price for a down payment. Some conventional programs offer financing for as little as 2% down. FHA requires approximately 3% down. VA has no down payment requirement. The more you put down and the longer the term of the loan, the lower your payments will be. On a conventional loan, if you don't put down at least 20%, you will have to pay private mortgage insurance, also known as PMI. PMI could add $25 to $100 per month to your monthly payment, depending on the amount that you finance. Interest rates. Each type of mortgage carries its own terms and conditions, including interest rates. There are several variables that affect what your interest rate will be: the type of loan, the number of points you're willing to pay, whether it's variable rate or a fixed rate, the length of the loan, the amount of the down payment. Fixed versus adjustable rate mortgages. With a fixed rate mortgage, the interest rate stays the same for the full term of the loan. Whereas with an adjustable rate mortgage, the interest rate changes periodically to reflect changes in the current interest rates. A typical ARM rate will adjust by no more than 2% per year. Typical maximum lifetime adjustment of 6%. Initial rate on an ARM is usually lower than that of a fixed mortgage. You may be able to qualify for a larger mortgage with an ARM. However, the interest rate could increase, making your budget tight. Interest paid is less on the front end of an adjustable rate mortgage than a fixed rate. If the interest rates are stable or decreasing, an ARM could save you a lot of money, especially on a shorter term loan. If interest rates are rising, a fixed rate loan may be the best option. With an ARM, you would pay a lower interest rate on your loan when the balance is the highest, the early years of the loan. Choosing an ARM or a fixed rate should be based on your situation. Do you get annual raises or do you rarely get raises? Do you have a spouse who's working now but will be able to work in the future? How long do you intend to stay in the house? 3, 5, 20, 30 years? Will you be comfortable if the rates go up? Do you have enough savings to refinance the loan if the interest rates rise? Can you handle the higher payments? Points. Points are fees sometimes charged to you by the lender under various types of loans, which help establish the interest rate of the loan. A point is a percentage of the loan amount. You can pay points to buy down your interest rate. So here's an example of buying down your interest rate for the loan amount of $150,000. Today's rate is 8% with no points, no additional cost to you at closing. You could have 7.75% if you pay 2.5 points, an additional cost of $2,500 at closing. Or you could have 7.5 if you pay 3.5 points, an additional cost of $3,500 at closing. Why would you want to pay points to buy down your rate? You could qualify for a higher purchase price with a lower interest rate. You will save a lot of money over the life of the loan with the lower interest rate. However, if you're not going to stay in the house long enough to cover the upfront cost of the buy down, paying points is not a good deal for you. Length or term of loan. The longer the term, the lower your monthly payment. The longer the term, the more interest rate you will pay over the life of the loan. Lenders are flexible with the length of a mortgage. Most loans are 15 to 30-year loans. However, you can also get 20 to 25-year loans. Some advise that you take the shortest loan you can afford. Some advise that you take the longest term and double up on your payments when you have the extra money. Others suggest that you pay a little extra each month. All of these choices will save you money. Other fees and expenses. There are many other fees involved with doing a loan. They're called closing costs. The loan officer should give you an estimate of what those fees will be. It's called a good faith estimate. The fees may vary between these types of loans. Closing costs can run from 3 to 8% of your loan amount. Common closing costs: your origination fee, discount points, credit report fee, appraisal, title insurance, recording fees, underwriting fees, commitment fees, settlement or closing fees, state transfer tax, survey, odd days interest, homeowner's insurance, and property taxes. When you leave the lender, you should know 4 things: how much the lender is willing to lend you based on the information you provided, how much of a down payment you will need to have, the maximum price of a home you can afford, how much money you will need for your closing costs. The process: see a mortgage lender for pre-qualification. If you have no issues that need to be resolved, apply for a pre-approval. Once you receive your pre-approval, contact a realtor and start looking for homes. When you find the home, write up a purchase agreement, notify the lender of your accepted offer, and provide them with a copy of the purchase agreement. Once all of the documentation is in and the appraisal has been done, the closing can be scheduled. Request to see copies of the closing documents a couple days before the closing. Review the closing documents and make sure that you understand them. Go to your closing and sign the papers. You will write out a check to the closing agent for the closing costs you owe. and you will receive the keys to your new home. Tax ramifications. You may be able to deduct interest you pay on your mortgage and home equity loan along with your real estate taxes. This assumes you itemize deductions. Summary. Buying a home is a highly specialized market which changes constantly. If you are in the market for a mortgage, refinance, or equity loan, there are a lot of things to learn. Just because you learned the rules once does not mean that you know the current rules. Questions, comments, experiences. For more financial education or to make an appointment with an accredited counselor, you may call us at 877-202-9246 or visit us at www.yourgfm.org. Thank you for viewing this video. We hope to have helped you in some way.